Stop looking at the spot price for a second. The game just changed. We are no longer talking about an investment thesis, we are talking about survival. The US government has just declared silver an issue of national security. This isn't a rumor from a forum, this is official. Silver, along with 40 other critical minerals, is the subject of the latest White House proclamation released yesterday. This document changes the legal status of the metal in your safe from a commodity to a strategic asset. Let's look at the timeline because it reveals the urgency. On October the 24th, 2025, the Secretary of Commerce transmitted a classified report to the President. It was an investigation into the effects of imports on national security. The conclusion was terrifying. The Secretary advised the President that these minerals are being imported in such quantities and under such circumstances as to threaten to impair the national security of the United States. Translation: the US military is naked, the US tech sector is hostage, and the supply chain is broken. Why is the White House hitting the panic button now? Because they finally looked at the math. As of right now, the United States is 100% net import reliant for 12 critical minerals. For another 29 minerals, the reliance is over 50%. And here is the number you need to memorize. For silver, the United States is 69% dependent on foreign imports. Think about what that means for a superpower. Silver is indispensable. It is in national defense systems. It is in critical infrastructure. It is in advanced weapons systems and energy grids. It is the best conductor of electricity on the periodic table. It is the gold standard for electronics. You cannot fight a modern war without silver. You cannot build an AI data center without silver. Yet, almost 70% of it comes from outside the borders. And it gets worse. Even where the United States has domestic mines, the United States lacks the domestic processing capacity. That means we might dig the ore out of the ground in Nevada, but we have to ship it overseas to be refined. We are digging it up and handing it to foreign nations to process. If those supply chains get cut, the lights go out. The missiles don't fly, the economy stops. The proclamation states clearly that demand is rapidly increasing. Artificial intelligence, data centers, nuclear energy, they are all hungry for silver, and the supply is prone to price volatility. The government is admitting that they are vulnerable, and when a government admits vulnerability, they don't just sit there. They act. They take control. We are moving from a free market to a secured market, and you need to understand what that means for your portfolio before the new laws kick in. You might be thinking, okay, the government is worried, but is there actually a shortage right now? Or is this just bureaucratic fear-mongering? Let's look at the evidence on the ground. And the evidence is screaming that the vaults are running empty. We have received reports from Europe regarding the British Royal Mint. This is one of the most prestigious mints on the planet. They have effectively stopped producing silver bars. They are now exclusively producing silver coins. Why would a business stop selling one of its most popular products? Because they don't have the metal. It takes a lot of silver to make a 100-ounce bar. It takes very little to make a 1-ounce coin. When you're running out of silver, you switch to coins to stretch your supply. You prioritize the high-premium items. This is rationing disguised as product strategy. It is the same story at the Perth Mint in Australia. Bars are disappearing. Coins are the only thing left. And here in the United States, look at the production numbers from the US Mint before they went dark. They were producing silver eagles at 1/6 of the volume compared to 2024. 1/6. That is not a slowdown. That is a collapse in supply. The White House proclamation admits the ugly truth. Even where the United States has domestic mining capacity, the United States lacks the domestic processing capacity to avoid downstream net import reliance. Translation: we can dig the rock out of the ground in Nevada, but we don't have the factories to turn it into pure silver bars. We shipped all that infrastructure overseas years ago. We are dependent on foreign refiners to process our own metal. So if China decides to stop exporting refined silver tomorrow, it doesn't matter how much ore we have in the ground. We can't use it. We can't build missiles with raw ore. We can't build solar panels with rocks. This is the physical deficit. It is real. It is global. The mints are rationing. The supply chain is broken. And the paper price on your screen has not yet realized that the physical world is running out of inventory. We are watching the end of the era of abundance. If you want a silver bar, you are fighting against the US military and Apple and Tesla for the same ounce. And guess who is going to win that fight? In the fog of financial war, it becomes incredibly difficult to distinguish the signal from the noise. When you have a market moving vertically and governments invoking national security protocols, the rumor mill goes into overdrive. And right now, the internet is on fire with stories that sound too good to be true. And usually when something sounds too good to be true, it is. We need to address the biggest rumor out there, the UBS story. You have probably seen the headlines on social media claiming that the Swiss banking giant UBS is naked short 5.2 billion ounces of silver. The story goes that they are trapped and about to blow up the entire global financial system. Let's apply some critical thinking and basic math to this claim. 5 billion ounces. Do you realize how much metal that is? The entire global mining industry produces less than 1 billion ounces a year. So, this rumor suggests that one single bank is short 8 times the annual planetary supply of silver. At current prices, that position would be a liability of nearly $500 billion. That is roughly 1/3 of UBS's entire balance sheet. If a bank of that size was facing a solvency crisis of that magnitude, do you think the insiders would be sitting quietly? We checked the data. We looked at the insider trading reports for UBS. If the ship was sinking, the captain and the crew would be the first to jump. We would see massive selling of UBS stock by executives. But over the last 90 days, there has been zero significant insider selling. In fact, there has been net buying. Does that look like a bank that is days away from collapse? No. If the 5 billion ounce number was real, the system would have imploded already. So, my advice is simple. Do not bet the farm on an internet rumor that makes no mathematical sense. It is likely a distraction. However, you do not need fake rumors to find real blood in the water. There is a bank that is bleeding, and they are bleeding profusely. We need to talk about TD Securities, the Toronto Dominion Bank. This is the real story. This is the smoking gun. 6 months ago, their own analysts wrote a report admitting that the silver squeeze is happening in the physical world. They saw it coming. They identified the trend. And then, in a display of breathtaking arrogance, they decided to bet against it. In October 2025, with silver trading at $48, TD Securities opened a short position. They told their clients the price would fall. They were wrong. The price ripped higher. By the end of the year, silver was at $78. Did they cover? No. They doubled down. They opened another short position, predicting a swift collapse back to lower levels. They were fighting the tape. They were fighting the physics of the market. And yesterday, on January 15th, the fight ended. Reuters reported that TD Securities has officially closed their silver short position in their model portfolio. They took the loss. They capitulated. This is significant because it proves that the smart money is not smart. They had the research. They knew about the physical shortage, but they still tried to play the paper game, and they got burned. When a major bank closes a short position, they become a buyer. They have to buy back the contracts they sold. This creates upward pressure on the price, and TD is likely just the first of many. We are also seeing massive liquidity injections from the Federal Reserve. Over $420 billion in bank bailout funds have been deployed recently. This suggests that while UBS might not be the culprit, the banking sector as a whole is under immense stress from these rising commodity prices. So, here is the reality check. The 5 billion ounce rumor is likely fake. But the pain at banks like TD Securities is very real. The shorts are trapped. they are being forced to cover at higher and higher prices. This is what a short squeeze looks like in the institutional world. It isn't a straight line-up. It is a series of capitulations. One bank folds, then the next, and every time they fold, the floor price of silver moves higher. We are watching the paper masters losing control of the physical asset. TD Securities learned their lesson the hard way. Do not let their exit be your entry. The trend is up and the banks are running for the exits. While investors in New York act nervous about silver hitting $90, the traders in Shanghai are laughing. They aren't asking if silver is expensive. They are asking, how much more can we get? We need to talk about the China gap, because right now there are two prices for silver on this planet, and the gap between them is draining the West dry. Yesterday, silver closed on the Shanghai exchange at the equivalent of $101 per ounce. Compare that to the COMEX price in New York, which is struggling to hold $90. That is a spread of nearly 11%. In the world of high-frequency trading, that is not a gap. That is the Grand Canyon. This creates an irresistible force called arbitrage. It is simple physics. Metal flows from the low price zone to the high price zone. Right now, there is a giant vacuum cleaner hovering over London and New York, and it is sucking every available bar of silver and sending it east. The Chinese market is signaling that they expect prices to go much higher. We are looking at the options data from Shanghai. The volume is concentrated on call options, with strike prices at $117 and $123. They are betting aggressively on a breakout. Even more telling is where they are hedging, the put options. The insurance against a crash are sitting at $98. Think about that. The Chinese traders are treating $98 as the floor. Meanwhile, American traders are treating $90 as the ceiling. This disconnect cannot last. Eventually, the water levels must equalize, and the water is rising in the east. But there is a twist, a geopolitical twist that stops this from being just a trade. The United States government knows this is happening. They know their strategic stockpile is being drained by their biggest rival. In the National Security Proclamation, the White House explicitly mentions implementing trade-restricting measures. What does that mean? You can't force a foreign country to sell to you, but you can certainly stop your own citizens from selling to them. This is code for export controls. China already made the first move. 2 weeks ago, they implemented export controls on silver, preventing it from leaving their borders. They are hoarding it for their solar panels and missiles. Now the United States is preparing to do the same. If the US bans silver exports, the global market fractures. We will no longer have a spot price. We will have a US price, a China price, and a European price. The liquidity will dry up. The supply chains will snap. If you are holding paper silver that tracks the global price, what happens when there is no global price? What happens when the COMEX can't deliver because the metal is locked inside US borders or stuck in a Shanghai vault? The China gap is the most dangerous signal in the market right now. It tells us that the West has lost pricing power. We are the discount bin of the world. And soon the store manager is going to lock the doors to stop the looting. $101 is not a target. In Shanghai, it is already the history. The future is much higher. We have talked about how the government plans to stop metal from leaving. Now let's talk about how they plan to force metal to come in. This is the part of the White House proclamation that almost everyone missed, but it is the most explosive part for the price action. The document explicitly states that the Secretary should consider price floors for trade in critical minerals. Let's stop and think about what a price floor actually is. It is the opposite of price fixing. Usually governments try to keep prices down to fight inflation, but here they are proposing the exact opposite. They are proposing a guaranteed minimum price to attract supply. Here is the game theory. Let's say the global market price for silver is $90, but the US is desperate. They need the metal for missiles and AI chips, so the government sets a minimum import price of $100. Basically, they are telling every miner in the world, If you ship your silver to an American port, we guarantee you $100 an ounce. Even if the market crashes, we pay you $100. What does a miner do? It is a no-brainer. They stop selling to London. They stop selling to Tokyo. They send every single ounce to the United States because Uncle Sam is paying a premium. The US effectively corners the market by outbidding the rest of the world. But the story doesn't end there. The rest of the world still needs silver. Samsung and Sony and Volkswagen cannot just stop making products. When they see all the silver flowing to the US, they panic. They have to match the price. They have to bid $105 to get their share. So now the global price is $105. The US flow stops. What does the US government do? They raise the floor. They bid $110. Do you see the cycle? It is a continuous bidding war where the United States government acts as the ultimate whale. And unlike a hedge fund or a corporation, the government has infinite liquidity. They can print the money to pay the premium. They are using taxpayer funds or debt to subsidize the accumulation of silver. This completely destroys the old pricing model. The price is no longer set by paper traders on the COMEX. It is set by the desperation of the Department of Defense. This creates a ratchet effect. The price can go up easily, but it cannot go down because the government has put a concrete floor underneath it. They have become the market maker. This is exactly what the Proclamation warns about. It says they will consider alternative remedies to combat price volatility, but by setting a floor, they are actually guaranteeing that the price moves higher. For an investor, this is the ultimate safety net. You are no longer fighting the Fed. You are front-running the Fed. You are buying the asset that the government has legally committed to acquiring at above market rates. This is the definition of a rigged market, but for the first time in history, it is rigged in favor of the silver holder. The government is willing to pay any price to secure the metal, and the rest of the world will have to pay even more to compete. We have analyzed the metal. We have analyzed the politics. But there is one corner of this market that is screaming opportunity louder than anything else. If you are looking for asymmetric returns, this is where you need to focus. We need to talk about the mining stocks. Logic dictates that if the price of the product goes up, the price of the company selling that product should go up too. If oil goes to $200, ExxonMobil stock should double. It is basic math. Higher revenue equals higher profit. But right now, the silver market is breaking the laws of math. Silver is trading near $90 in the West and over $100 in the East. Yet, when we look at the stock prices of the major silver miners and the junior explorers, they are trading as if silver is still at $35. This is what we call the miner anomaly. Why is this happening? It is fear and disbelief. Investors have been battered by a bear market for over a decade. They look at this silver rally and they don't trust it. They think it is a spike that will crash back down. So they are afraid to buy the stocks. This skepticism is your best friend. It has created a valuation gap that is frankly ridiculous. Look at the ratio of the S&P 500 versus the commodity index. We are currently in an everything bubble. Real estate is expensive. Tech stocks are expensive. Bonds are expensive. The only thing that is historically cheap is commodities. Let's look at a specific comparison. Back in 2021, we had a mini bull run in silver. Back then, junior mining companies with decent projects were valued at $100 million or more. Today, those same companies have better projects, more drilled reserves, and the price of silver is triple what it was in 2021. Yet their market cap is sitting at $75 million. They are cheaper now than they were when silver was $30. This disconnect cannot last. In financial markets, gaps always close. Nature abhors a vacuum and the market abhors a mispricing. We are currently in phase 1 of the bull market. Phase 1 is driven by fear. People buy physical metal because they are scared of inflation or war. They want safety. They are not thinking about PE ratios or dividends. Phase 2 is driven by greed. This happens when the Wall Street analysts wake up. They will run their models and realize that at $100 silver, these mining companies are trading at 1 times free cash flow. They will realize that these companies are about to pay massive dividends. When that realization hits, the capital will rotate, and it will rotate violently. Think of it like a rubber band. The silver price is stretched way up high, but the mining stocks are held down by fear. The tension is building. When that rubber band snaps, the stocks will slingshot past the metal. We already saw the banks like TD Securities capitulating on their short positions. That was the signal for the metal. The signal for the miners will be when the generalist funds start panic buying into the sector because they have zero exposure. They are overweight AI and underweight resources. When the tech bubble deflates even a little bit, that money has to go somewhere. And the resource sector is so small that even a tiny trickle of capital from the S&P 500 will send these stocks to the moon. Buying physical silver is how you stay rich. Buying mining stocks before the crowd arrives is how you get rich. The herd is still grazing in the tech field. The smart money is already positioning in the mines. We have covered the theory. Now let us talk about action. Which companies are actually sitting on the silver that the US government is so desperate to secure? And more importantly, which of these companies is the market completely ignoring? Based on deep data analysis from our partners at Exino Capital, we have identified 3 specific case studies that perfectly illustrate the miner anomaly. Disclaimer, we are transparent here. We hold positions in these sectors. This is analysis, not financial advice. Do your own due diligence. First up is Sonoro Gold. Don't just look at the stock chart, look at the map. Sonoro has aggressively expanded their Cerro Caliche project. They acquired a new concession and crucial surface rights for the Cerro Prieto Ranch. By September 2028, they will control the surface rights for the entire area. This is a land grab play. While the rest of the market is chasing AI stocks, Sonoro is securing the physical ground that contains the money. They are positioning themselves to be bought out by a major producer right when the supply crunch hits its peak. This is playing the long game in a market of short-term thinkers. Next, we look at Arizona Gold and Silver. This is what momentum looks like. The stock has already doubled from around $11 to nearly $24. Why? Because they are hitting production records during a silver boom. This proves that companies that can actually pull metal out of the ground right now are being rewarded. But even at $24, they are trading at a discount compared to where silver is heading. If silver goes to $150, this stock is just getting started. But the most insane example of mispricing is metallic minerals. Let's compare today versus 2021. Back in 2021, during the last silver mini rally, metallic minerals was valued at around $100 million. Fast forward to today, they have advanced their massive silver project in the Yukon. They have added a copper project in the US. And most importantly, Newmont, the biggest gold miner in the world, bought in at 40 cents. So they have better assets. They have Newmont's backing. And the price of silver is triple what it was in 2021. So the stock must be skyrocketing, right? Wrong. The market cap today is only around $75 million. Think about that. The company is worth less today than it was 5 years ago, even though everything about it has improved and the commodity it sells is in a historic bull market. This is a glitch in the matrix. It is a broken valuation. And for an investor, it is a gift. You are buying a better company at a lower price in a better market. Gaps like this do not stay open forever. Conclusion: the perfect storm. Let's bring it all home. What we are witnessing is not a trade, it is a paradigm shift. 1. The US government has declared silver a national security asset. They are preparing to set price floors and print money to secure supply. 2. The physical market is breaking. The mints are rationing. The bars are gone. 3. China is draining the West. The arbitrage gap is wide open and export bans are coming. 4. The mining stocks are asleep at the wheel, offering a once-in-a-lifetime entry point before the rubber band snaps. This is the perfect storm. It is a wealth transfer from those who hold paper to those who hold real assets. But the window is closing. Once the export controls kick in and the price floors are set, the free market is over. You will be locked out. Do not be the person who watches this video in a year and says, "I knew it, but I didn't act." The signs are clear. The government has shown its hand. Get physical, get invested, and get ready. The silver blackout is here. Thanks for watching.